Good afternoon, and thank you for joining us for this webinar, Bonds 201. My name is Dylan Gibbons, and I'm the Staff Director for the State Debt Management Network, or SDMN, a network of the National Association of State Treasurers. This webinar, which is being recorded, is part of SDMN's ongoing efforts to provide educational opportunities for new debt managers as well as seasoned veterans. We hope you enjoy this webinar and look out for an invite to future webinars. During this webinar, you're going to hear from experts on the topics of bond proceeds investment management, positive arbitrage, eligible investments, the official statement offering, and the current market. If you have any questions, please type them into the Q&A section of the webinar, and our presenters will get to as many questions as time allows. We will follow up on any questions we may not have time to get to. So without further ado, let me turn it over to one of our presenters, Lisa Eisenberg, Director of Debt Management at the Ohio Treasurer's Office. Lisa?
Thank you, Dylan, and welcome everybody. Thanks for sharing some of your afternoon with us today. The topic that Dylan just mentioned we'll be talking about today, bond proceeds management. Our session is really intended to follow up from Bonds 101, which a session you may have already listened to or participated in, discussing kind of the overview of a bond transaction and what brings a bond sale to life. After a transaction closes, there's still a lot of work to do and a lot of compliance that needs to be done, and that's what we're going to be talking about today. So my name is Lisa Eisenberg. I'm the Director of Debt Management here at the Ohio Treasurer's Office, and I'll toss it over to my colleagues Laura and Sandy to introduce themselves.
Hey, good afternoon. It's Laura Glenn with Public Trust Advisors, where I serve in a role as Senior Director of Investment Advisory, working with cities and states across the country on this very topic. And prior to my role at Public Trust, I spent 24 years at the state of Georgia, part of our role, which was managing the unspent bond proceeds, which I'll talk about today.
All right, great. Thanks, Laura. And this is Sandy Stallings. I'm with BLX Group. I'm the Chief Operating Officer and a Managing Director, and have been providing arbitrage services for clients coast to coast for over 3 decades. So look forward to presenting to you this afternoon. Thank you. Thanks, Lisa.
Thanks, Laura and Sandy. So, like I mentioned, today we're going to talk about what happens after the bonds are sold and how to manage your bond proceeds. There are several strategies on the issuance side that can really help ease your bond proceed management and set yourself up for success. And I also want to highlight too that today we're talking about managing tax-exempt bond proceeds. So that tax exemption is viewed as a subsidy to states and local governments by the federal government. And of course, subsidies all come with strings attached. And so making sure that we're complying with those rules, reporting requirements, and things like that is very important, not only on the issuance side in completing the tax analysis and tax diligence, but following up and managing your bond proceeds. And so managing how your bond proceeds are spent during the issuance process could take the form of getting buy-in and participation from those that may actually be using your bond proceeds. So that might be a capital or building improvements team. It could be a project manager. It could be a separate fiscal area, procurement, others in your other finance functions. And so oftentimes, as debt managers, we're not the only ones, or we may not be the ones ourselves actually writing the checks and spending that bond proceed money. There might be a project manager who's approving disbursements and approving changes to terms with contractors and things like that throughout the life of a project. And so involving others that are responsible and others that will benefit from the bond proceeds is really important. So continuing to educate others internally about the general permitted uses of bond proceeds will help you on the tax compliance side. It'll also help you learn more about how quickly and how much bond proceeds you may need to generate during the issuance process as well. So establishing those lines of communication early, good working relationships with others will definitely help you throughout the issuance process. And I would be remiss if I also didn't mention to consult your bond counsel early and often too about questions and involve them as well. So the IRS has a few broad kind of categories that all of their different rules for tax exempt borrowing fall into. When you issue bonds, the proceeds have to be used for good qualified government purposes. We can't issue bonds on a tax exempt basis to build a state office building and then lease the entire thing out to, an insurance company or a real estate developer, right? We can't issue bonds to effectively build something to benefit a private enterprise. The assets and capital projects must benefit, our entire constituencies. The IRS rules also prevent us from borrowing too much money or borrowing too soon. They encourage us to borrow an appropriate amount of money to match our capital needs and to try and time that bond transaction as close to when our needs are actually incurring as much as possible. So the IRS wants to discourage us from issuing a $50 million bond because we think that interest rates are, favorable, and then sitting on that money for 5 years and not spending it. That's frowned upon, and the IRS rules and compliance required for your taxes and bond proceeds deter borrowing too much and borrowing too soon. The other thing that we're going to zoom in on today is earning too much interest. The federal government, again, views the tax-exempt borrowing as a subsidy. And so the investment of your bond proceeds, the investment earnings cannot exceed your interest costs on the debt. So we can't borrow at a low rate, turn around, take that $50 million, and then invest it at a high rate and profit off of the difference. Lastly, it's also our responsibility as bond issuers to demonstrate compliance with all these things. So at the beginning of your bond sale, bond counsel may ask you for things like spending projections, project descriptions, your budget, things like that. They may ask questions about contracts. And so that work is very helpful on the front end for those first 3 bullet points: qualified projects, borrowing on time, and borrowing the right amount of money. But the onus really falls on us for the last 2 bullets to demonstrate that we're earning the appropriate amount of interest, or if we over earn, then we're remitting that back properly, and that we're staying in compliance with everything that we said we were going to do in the tax certificate. I'll also highlight here that our responsibilities, if you can flip back, Dylan, our responsibilities for compliance last the entire life of the bond. So if you've got a 30-year bond transaction, your compliance responsibilities last that time horizon. So setting up good procedures, good communication, getting good processes in place is really important, because chances are maintaining compliance and following up on all of our duties here is probably going to outlast you or somebody else, in your current role. Okay, I'm good to go to the next slide. So to reiterate what I mentioned, coordination with other stakeholders is really important at the beginning of a bond sale during the pre-issuance phase. At Ohio, for our Treasurer's Office bond sales, we make a concerted effort to work with the budget team and also the department that benefits from the bond proceeds. This ensures that our budget is appropriate, our draft disbursement schedule is reasonable, and that from a budgetary perspective, we're not running up against any budget or appropriation issues as well. We also share and discuss these with bond counsel as well. And we'll get into this a little bit more on the next slide, but if we're able to craft our disbursement in a way that we're spending that we expect to spend the bond proceeds quickly, we can try and target these spending exceptions. These are different targets that the IRS will essentially reward you for issuing your bonds timely and in a sufficient amount that you're allowed to keep any additional interest earnings above your bond yield. And so that, depending on your project and use of the bond proceeds in your disbursement schedule, that might be something to keep in mind when you're developing your budget. Additionally, you can work with bond counsel to sign the declaration of intent and plan to use your bond proceeds to reimburse prior qualified expenses. So that would be an immediate spend of your bond proceeds and definitely help you to meet those spending exception targets. So that, I think, is definitely something to explore with bond counsel and your budget and fiscal teams to see if cash is available to front some of those costs for reimbursement. And again, communicating with bond counsel early and often to ensure that you know what targets you're looking to meet if you're signing an intent of reimbursement. And then also work with your bond counsel too to understand what your eligible investments are for your bond proceeds. That's typically discussed or outlined in the trust indenture, and understand what sort of investment options are available to you after the bond sale closes, and you know what your investment options are so you can stay in compliance. So these are the spending exceptions that I mentioned earlier. They fall into 3 different categories: a 6-month, an 18-month, and a 2-year spending exception. And the bullet points here, I'm not going to read all of them, outlined how quickly you need to spend a certain percent of your bond proceeds in order to meet the spending exception. So these are not a mix and match. You've got to meet, you know, in the case of the 18-month spending exception, all 3 benchmarks in order to qualify. And these are really nice ways for issuers to get rewarded for following the IRS's rules to size and time their bond sales appropriately. And lastly, after you issue the bonds and we get our $50 million in bond proceeds, now we've got to put our plan into action, right? The capital team or the project team is going to be looking to start spending their money. We're going to want to track that against our initial disbursement estimates and determine an investment strategy for the bond proceeds. So again, referring back to your eligible investments definition, funding any reserve funds or project funds, paying attention to that, working with your bond trustee and counsel as needed is going to be very important. And then also tracking the project fund spending and interest earnings. That's going to help you maintain your tax compliance and get your arbitrage and rebate reports prepared. So kind of going back a few slides, setting up good record keeping procedures, good lines of communication with your project teams are all going to be very important to helping you prepare these reports with ease and stay in compliance with the tax code. So Ohio does this monthly. We track our project funds, spending, and interest earnings monthly. We work with a rebate consultant to get our arbitrage reports prepared on a semi-annual basis to help ensure our compliance with the tax certificate. And I would also be remiss if we didn't mention just how important bond counsel and our external advisors are for helping us navigate any issues as they pop up. So Laura and Sandy are both great resources. I will now pass it over to Laura to talk about investment of bond proceeds and some strategies here.
So good afternoon from very rainy and stormy Savannah, Georgia. So hopefully I don't get overshadowed by this big thunderstorm behind me that you can probably hear. But so great. Once you issue the debt, then you actually have the bond proceeds. And so what do you're not going out and building that project right away. So there's the management of these bond proceeds, the investment management. And so one of the resources that we like to refer clients to is that GFOA, or the Government Finance Officers Association, recommends that governments have an investment policy which takes into consideration all inherent risk and also includes specific policies for the investment of bond proceeds to ensure that legal, which Lisa talked about earlier, legal and regulatory requirements are met, fair market value bids are received, and issuer objectives for various uses of proceeds are attained. And so the best practice is focused on the investment of these bond proceeds. And so I'm not going to go through this line by line, but if you will flip to the next slide, Dylan. So I think this is some of the recommendations that we would agree to. So the recommendations, number one, issuers should include a section in their comprehensive investment policy relating to investment in bond proceeds. This section should address the bond indentures permitted investments and other investment requirements related to bond proceeds. In the event that there is no bond indenture, the bond proceeds section of the investment policy should be specific as to permitted investments that may be a subset of the permitted investment of the government's operating funds. So you will see from time to time that a state or a local government may have specific investment options for general, just their operating funds, but then there will be maybe some that are a little tighter when it comes to the debt issuance. Issuers should be aware of unique considerations related to investing bond proceeds, such as multiple accounts that may be required for a bond issue. I know when I was at the state of Georgia, we would have debt would be underwritten, and then it would come over, and there would be, the CAPI, you'd have the debt service reserve fund, and then the capital project fund. So a lot of that was set up separately to keep those interest earnings segregated. And then again, the municipal advisor rule, or the MA rule, as it relates to investment advice on bond proceeds. So if you're going to get advice, it's got to come from someone who's registered as a municipal advisor. And then there's obviously the tax compliance issues, which Lisa has alluded to earlier, related to the tax-exempt bond proceeds. Issuers should coordinate the management of bond proceeds with the necessary staff in their government to ensure funds are invested and spent properly, and cash flow requirements are matched with investment maturities. So right there, I would highlight the most important thing that you want to do is make sure that you have cash available to meet various project deadlines, and then obviously to meet other things attached with the debt issuance. So I know for a while, a lot of projects might take 3 years. So we, at one point in time, would say, okay, you need to have enough cash in, some type of liquid investment, such as a local government investment pool, or maybe a bank deposit, or some other very short-term type of product. And then maybe, if a lot of the debt isn't going to be used for 2 years, you can actually go out and buy maybe 1 or 2 year treasuries that are going to mature just in time when you need those proceeds. But again, making sure that you're adhering to the fact that you're going to have cash that's needed in the first year, because the last thing you would wanted to have done, and we saw this, and I hope nobody on this call did this, but in the last year or two, we saw a dramatic rise in interest rates. So you would have hated to have sell a treasury to fund some type of cash outlay for the bonds. So obviously keeping cash in a liquid account in the last year would have been very beneficial as interest rates rose. So you're earning a very attractive rate without having to worry about cash flow. So factors influencing investment decisions. So structure of the bonds and the type of funds. So what I kind of talked about earlier is that you would have debt issuance, and then you would have separate accounts for proceeds for the project, capitalized interest, debt service reserve fund. So, some of these funds might be paid out right away. So you want to make sure that you have, again, money maybe in an LGIP or bank deposit account that can fund these types. And then other structures where you might be able to go out and buy a 1 or 2 year treasury and hold that and earn interest income for that period. And then cash flow schedules. So this, I would tell you, first and foremost, is the most important conversation you're going to have. Making sure that, if 50% of the project is going to, the proceeds are going to need it in year 1, making sure that you have those monies readily available. And then permitted investments. The last thing you want to do is have an auditor come in and tell you that you're invested in something that you legally cannot be invested in. So making sure, and I will tell you, many of you on this call, probably even in the last few years, have actually changed state code for maybe allowing new type of investments that you've never be able to purchase before. It could be something simple as maybe in the past you could only buy Fannie Mae. Now you can buy both Fannie Mae and Freddie Mac. So some of the information I know that gets in the trust indenture or the official statement, gets a little stale. You don't think it's changed. That looks good, and you kind of move on and you change the stuff. But I would tell you at least once a year to look through those permitted investment sections and make sure they are adhering to current code, because you might be also, eliminating something that you could be investing in that could be safe. I know there were in the past, we had states that could only invest in treasuries, and then they allowed for agency. So do you want to allow that with bond proceeds? And if so, then making sure that gets reflected in the OS and in other and bond indentures. And then current and expected interest rate environment. So what I talked about earlier is we've seen a dramatic rise in interest rates as the Fed's been very aggressively raising interest rates in the last year and a half. So if you had a project that you're not going to need to spend the proceeds, a majority of them for a year or 2 years, then you might want to consider, if you think rates are headed down, that maybe you actually extend out your duration and you buy a 1-year treasury or a 2-year treasury. But again, that goes back to two in this list of cash flow schedule, making sure you have those funds readily available. And then I'm not going to get into the weeds on this one, but the arbitrage rebate requirements, that's Sandy's expertise. I'm really going to let her get in the weeds on that, and we will in a few slides. So this is, I'm going to borrow from the state of Georgia. This is the OS from the Georgia issue that they issued back in 2022. And so you can see it simply lays out investment of state funds, very clearly a list, investment of general obligation debt proceeds. And I'm not going to read through, but if you need an example, this would be what you would see. And you'll see as we read just the first couple lines, the proceeds of general obligation debt shall be limited to 1, general obligations of the U.S. or of subsidiary corporations of the U.S. government, fully guaranteed by such government, so basically U.S. treasuries, obligations issued by the Federal Land Bank, Federal Home Loan Bank, Federal Intermediate Credit. The list goes on. And a lot of times this is going to mirror what's in state code. Some folks will just simply borrow what's in the state code. But again, if you're going to do that, making sure that you're reviewing that if there's been any changes to the state code. So this is from the OS as well. And again, just a kind of a screenshot picture for you of what it may look like. And so these were tax exempt bonds that were issued by the state of Georgia, let's call it 1.2 billion. And then it kind of goes through the security, the redemption, the purposer. And this is going to go through, as you go through the OS, you'll get to that section that will lay out bond proceeds. So just kind of a screenshot image to break up some words for you of what it would look like. So here's the fun part where I like to geek it out, as I say. So if you were in the room with us, this is the part where we get to kind of put pen to paper and make some decisions. So if you'll take your eyes to the bottom part of the screen, this was both the U.S. Treasury yield curve and the A-rated or better general obligation bonds that were issued back in 2002. So you can see the blue line being the treasuries. The treasuries were barely above, and actually in the very short end of the curve, the actual treasury yield was below where you were issuing debt at, where we call negative arbitrage. So for many of you on this call, you didn't even think about, there was really no thought process when you were thinking about where to invest along the yield curve. But that changed, and that changed dramatically from March of last year to this is the curve as it appears now on September 5th, 2023. So the yellow curve is where you are issuing debt. The blue line is where treasury yields are today. So look at that big dispersion, even from 3 months, 6 months, 1 year out to 2 years, and obviously as we get out to the 20, 30-year sector, you almost become, negative arbitrage again, or you're getting squeezed. But you have, for the first time in a long time, positive arbitrage. So where you decide to invest along the curve matters. And I think Sandy's going to talk to you, and I know she is because we've already done this presentation together, but she's going to tell you about maximizing out that arbitrage, just because you have no idea where rates are going. And she'll talk, I'm not going to steal her thunder. So just know she's going to give you that little nugget in just a second. But for now, just want you to see the difference between negative arbitrage or a very small arbitrage to a very positive arbitrage that we've seen in this last 18 months. So this is just a picture of, this is the S&P US AAA and AA rated government investment pool. So many of you in your states run local government investment pools, or even have, various pools that you can choose from, even money market funds. So this chart goes back to 2020, I believe. So 2020, you can see for forever, this is what I was talking about, when it almost didn't matter. You could just put your money in, if you invested in a 2-year treasury back 2021, you were earning about 12 basis points. Now you're earning close to 5%. But this is just a picture of a short-term cash investment vehicle, local government investment pool. So you can see this is a great place to park all the bond proceeds since Fed began raising interest rates in March of 2022. You can see this dramatic rise in interest rates, where most funds across the country are paying north of 5%. So paying somewhere in 5.25, 5.5. So a great place to park your cash and earn interest income over what you issued your debt at. And then, as I alluded to earlier, that, potentially the Fed is going to lower interest rates. And I think just to kind of give you a little snapshot, what you can see this dip down in the curve. The curve is barely, increasing, then it's dropping off. And that's where we call an inverted yield curve, because you're earning more to stay very short than you are as you go out the yield curve. But look at where we are. For many of you, you take your debt proceeds and you invest out in the 2-year treasury. Just the 2-year treasury from January 1st, 2022 to September 5th, a little snapshot. We're up 428 basis points in the 2-year treasury loan. It's been even more than that, or could be more than that. But eventually, if you think the Fed is done, then you might say, hey, we just issued debt. We're in a cash investment vehicle right now, but we don't really need most of those proceeds for 2 years. Maybe you then think about laddering out, maybe buying 3 months, 6 month bills, 1 year. So that is part of the conversation that you'll want to have, is talking about cash flow, is can I invest out longer term, and can I lock in a higher rate for a longer period of time? And it's never been more attractive to do so. So with that, I think I'm done. And now Sandy gets to tell you, once you do all that, how you have to handle your arbitrage. Oh, I did have one more slide, sorry. So this is the Fed dot plot. Sorry, I forgot I had one more. This exciting, fun chart full of yellow, green, and blue. So after every Fed meeting, and they release it, the July one won't be released for another few days, but this is where the Fed thinks rates are going to be at the end of the year. So I circled as of the June meeting, and if you follow along with the Fed, you know that they raise interest rates another 25 basis points in July. But at the June meeting, they thought by the end of 2023 that the majority of them thought that rates would be somewhere around, the target would be somewhere between 5 and 5 3/4, 5.5, sorry, 5.5 and 5 3/4. We're already there. And so now we're starting to price in, do we maybe have one more Fed tightening? But I think the most important thing for you today, as we talk about where rates are headed in the next year or two, you can see that the Fed thinks by the end of 2024 that rates are going to come down from where they stand now. And just so you know, the market nor the Fed never gets it right. So don't worry if you don't get it right. But these are the smartest people and they never get it right. 2024, rates are coming down in 2025. So again, if you can put money out, the Fed funds target and the market is telling you, both the blue and purple line, the market, that rates are expected to go lower by the end of 2024 and 2025. So now with all of that, I'm going to turn it over to Sandy.
All right, great. Thank you for teeing up all those beautiful charts and all the positive arbitrage. So next slide, Dylan. So how is this positive arbitrage created? Basically it's your ability to borrow or issue your tax-exempt bonds and turn around and invest that $50 million in bond proceeds without incurring any additional risk. So it's that positive spread that Laura was just showing us in these graphs that basically is what you're going to have to remit back to the IRS. So there's a difference between these two markets because of this quote unquote subsidy that the IRS allows, basically allows you a reduction in your borrowing cost because the investors are willing to accept a lower rate of return because of that tax exempt nature of that interest. So this disparity is given rise, and the IRS refers to this subsidy or this ability to have this benefit as a subsidy coming out of their coffers. So we've obviously had negative arbitrage for well over a decade, maybe even 15 years. But, we have a lot of positive arbitrage. Laura showed those 400 basis points and for the foreseeable future. So possibly for the next year, we'll see rates that will continue to be high, and you have to be knowledgeable of these rules and what pots of money are invested at what rates so that you can deal with some of the arbitrage compliance. Many people on your team may not even be aware of what arbitrage is because they haven't had to worry about it for so long, right? So this is a very low-tech graph compared to Laura's beautiful technical graphs, but basically just wanted to kind of show you on the left-hand side, it's basically starting in 2008, and rates plummeted because of the financial crisis. And for almost 10 years, rates were very, very low, very obvious. We couldn't even earn, 50 basis points. And then in 2019, things got turned around. We were almost earning over 2%, which was great. We were almost seeing some positive arbitrage again, and then COVID hit. So then for the 2 years remaining after COVID, interest rates have slowly came down, and then obviously now are skyrocketing well above your potential threshold of a 2% arbitrage yield. So your rebate liability is going to depend upon how much you have invested and when you have it invested along this time spectrum. So you might have unspent proceeds remaining now when you're investing at almost 5%. But you may have accumulated a lot of negative arbitrage up front. So again, your end result of what your cumulative calculation is going to look like is going to be a weighted average of how you've invested along this time frame. You might have a reserve that's been there the entire time. You might have a project fund that was spent early on and had a lot of negative arbitrage. But again, it's going to be over the long haul. You're going to have to know what your cumulative position is and where you are in this cycle. So why is the IRS interested in all of these things, and why do they put in place all these rules? Well, basically, they're the U.S. Treasury, or they're the gatekeeper, for the U.S. Treasury. And this subsidy is seen as lost revenue to them. And there's trillions of dollars of tax-exempt debt on the market. So obviously, it's a very large subsidy that they're seeing. So these rules are basically put in place to minimize your incentives to issue more than you need. You may not be able to spend the money or meet an 85% reasonable expectation at closing. So you have to be able to demonstrate at closing that you really needed this money and you're going to be able to spend it quickly. Also, they're going to want to know, as Laura mentioned in the very beginning as well, Lisa mentioned in the very beginning, about if you issue now because rates are good, well, again, you have to be able to justify what your project cash flows look like and make sure that you're going to be on the right side of these rules, basically meeting a spending exception or having to deal with yield restriction compliance rules. And obviously, the rules are written so that you have the incentive to leave your bonds outstanding longer than necessary. The IRS does not like you stockpiling money when you could be prepaying bonds or repaying bonds. So these rules that this money is stockpiled, you have to worry about the rebate implications as well as yield restriction implications. And they would really rather you pay down those bonds as opposed to taking advantage of some additional subsidy. So there's two sets of rules that you have to be aware of, and you have to think of them as separate. They are overlapping, but they do have two separate types of timeframes we're looking at and different types of investments we're looking at. But on the arbitrage rebate front, it's basically looking at this positive arbitrage, quantifying it, and remitting it back to the Treasury. And it's done on basically a 5-year basis. Every 5 years, you have to figure out, do I owe, do I not owe? And if you owe, prepare the forms and get everything sent into the IRS. Whereas yield restriction is limiting the investment yield on yield restricted amounts only. And those yield restricted amounts may not be all of your bond proceeds. A yield reduction payment basically relates to yield restricted funds, and it looks and acts just like a rebate payment, but only relates to these yield restricted amounts. So basically, it's a payment that makes the yield on that investment go down to your yield on your bond. So it's basically authorized yield burning, but basically you're paying that excess spread back to the Treasury. So the next slide, Dylan. So what are these yield restricted amounts? So basically, you said in your tax certificate, or I said earlier that not all your bond proceeds would be subject to yield restriction. And in your tax certificate, you'll say, yes, I reasonably expect to spend 85% or more in 3 years. Therefore, you set up your project funds for this 3-year temporary period to where you're allowed to earn positive arbitrage. But at the end of year 3, if you still have money left unexpended, you have to yield restrict it. So you get arbitrage runs for 5 years, but yield restrict starts from year 3 and works forward. Also, amounts in excess of a reasonably required reserve are required to be yield restricted. Again, this limits the ability to stockpile and leave excess amounts set aside. And the IRS wants to know about this because, again, they'd rather you prepay those bonds than leave this money sitting in a sinking fund or some type of a reserve fund. Also, prior to 2017, back when you could do tax-exempt advance refundings, the IRS really did not like advance refundings, and that's why they eliminated them in 2017, because it's two sets of bonds, tax-exempt bonds on the market at the same time, right? You have your old refunded bonds going to be refunded, but they're not yet at a call date. So you established an escrow with a tax-exempt bond issuance, which is also drawing a subsidy. So those two bonds on the market at the same time, the IRS really wanted to limit that, and you could never earn any positive arbitrage on an advance refunding escrow. You'll remember you hired a verification agent to confirm the yield on the escrow was below the yield on the bonds. Also, transferred proceeds are subject to yield restriction. If those amounts are left unspent in a bond that gets refunded, they move to the new refunding bonds. And obviously, if you're at a point where you could refund the issue, but you haven't spent all the money, then the IRS sees that as potentially abusive. Like, why didn't you spend the money? Okay, so we're going to bring it over to the new bond issue at a lower ARB yield. It also has to be not only subject to rebate at the new refunding bond yield, it's subject to yield restriction as well. So keep that in mind when you're trying to figure out what amounts are subject to yield restriction and how to quantify, am I at a potentially positive yield restriction situation? And many issuers are in this situation right now. They've issued bonds in 2020 and 2021 at very, very low bond yields, less than 1%, definitely less than 2%. And if they have unspent money, we're now at the third anniversary date. So you're basically seeing funds invested at 5%. You've issued bonds at 2%. That's a 3% positive spread you're gaining on these proceeds. So you need to think about that and quantify that going forward. And you don't get the benefit of the negative arbitrage that you earned from 2020 until 2022 when rates spiked up. So we're seeing a lot of clients in this situation where they're going to owe a yield reduction payment on those yield restricted funds, even though they're not going to owe a quote unquote rebate payment because the rebate time window or the reporting timeline is slightly different. So how do we prepare for positive arbitrage? Well, like I just mentioned, be mindful of your arbitrage yields. Really, really low ARB yields in the last 5 years. So those types of bond issues that have unspent money, creating a lot of positive arbitrage. And you need to know if you have unspent money, how much is left, how much negative ARB cushion do I have? Be looking at those types of issuances. Also, you have some additional exposure on short-term bond issues or variable rate debt, right? Because those types of arbitrage limits or bond yields can be a moving target or very low just by nature of the issuance. So, and variable rate deals, you don't even know what the arbitrage limit is until after the fact, right? So you're going to pay the interest rate on the bonds for the last 5 years, and you're going to look back, what did I pay? And then compare that to what I earned. So it makes those types of computations and knowing whether or not you're in rebate or yield restriction compliance even more challenging. Also, on short-term notes or commercial paper, these other type of variable rate instruments, there could have potentially less than a 5-year computation period, right? So you have to be mindful of what is the time frame. Do I have a full 5 years? Maybe I only have 3 years, and then I have to compute arbitrage. So be mindful of these things. And also, we had a lot of clients who did some restructurings of their variable rate debt, and it accelerated the final computation date. So be mindful of the tax treatment anytime that you're doing a remarketing of debt to make sure it doesn't constitute a reissuance, which could trigger potentially a rebate payment or a yield reduction payment at that point. So also, as we're dealing with positive arbitrage, you want to try to take advantage of the spending exceptions. And Lisa spelled out for us the different benchmarks. Again, these are all or nothing tests. There's always some exceptions to every single rule, but basically you have to try to spend all of the money, both the original proceeds as well as the investment earnings according to those timelines. And it's going to take advanced planning. You know, what can you reasonably expect to spend in 2 years? And you try to get those before you do a new issuance. Think about these types of expenditures and cash flow so you can take advantage, because it could mean, you know, potentially millions of dollars that you could keep as opposed to remitting back to the IRS in the event you could meet a spending exception. Also, you want to make sure you're keeping an eye on this bona fide debt service fund exception, basically meaning that the money's going into a debt service account are basically or roughly the amounts leaving the account within a given bond year. If you build up an excess, then even those monies that are not part of the original sales proceeds get pulled into these computations. And so you need to be mindful of what's happening with the debt service accounts. So you're not stockpiling a large reserve or large excess there. And then for additional issuers that issue variable rate debt, there's an additional $100,000 test on this. Even if it's bona fide and you earn over $100,000, it could be pulled into these arbitrage calculations. The small issuer exception is another exception, but again, it's not exempt from exemption from rebate, but not an exemption from record retention or yield restriction. So be mindful of those types of structures still needing to be demonstrate compliance. And then also on just being prepared for making an arbitrage payment, you be sure you want to make it on time. You do not want to make a late payment. So anything paid after 60 days after your installment computation date, which is generally the 5th bond year or the 5th anniversary date. If you make it late, you have to make a late payment explanation as well as late interest. Late interest is currently being calculated at 7% according to the IRS guidelines. So that's a pretty hefty sum if you don't make it timely. And there's also the potential for a 50% penalty of the rebate amount that wasn't paid when it was due. So these interest amounts and penalties can add up quite quickly. So you need to be mindful of when amounts are due to the IRS, be sure it's quantified quickly, get your forms prepared, and get everything remitted. It's a simple form, 8038T, remitted payment to Ogden, Utah. Basically, it's just a copy of the 8038T and a check. And the IRS does not want to see any filings unless there's a check attached to it. But basically, you want to make sure that you get it paid timely, because if you have to make a late payment explanation, they're going to review that letter and then they're going to determine whether or not it was willful neglect. So be sure that if you save yourself a lot of trouble, if you can get those payments made within those 60-day windows. All right, so real quick, most common compliance kind of fumbles or some mistakes that have happened. Basically, you need to make sure that you retain access to any accounting systems. Almost every single client that I've worked with has undergone some type of an accounting system change in the last 5 to 10 years. And it's just technology is changing so rapidly. So obviously you have to, though, be able to retain access to those old systems, because in the event of an audit, it's not going to go over well with the IRS if you say, oh, well, that was prior to 2015 and we don't have access to that old system anymore, right? So you're going to have to be able to access these old records for as long as the bond issue is outstanding, plus 3 additional years. And then if the bonds are refunded, it could be potentially 3 more years after the refunding bonds are paid off. So just be mindful that you need to be able to maintain all these records and have access for a really long period of time. Also, issuers sometimes just fail to keep these adequate records or keep them accessible. So today's technology, everything is saved as a PDF or some other types of files. Are those types of file systems going to be accessible in the future? 10 or 15 years ago, everything was sent out on a CD or some types of a disk. And nowadays, computers don't even have disk drives to be able to read those disks. So think about staying on top of the current technology trends and make sure all these things are accessible. Also, the third item or the third kind of fumble is paying off your bonds and failing to do a final arbitrage report timely. Just not being aware of this final computation date or not letting your consultant know. Obviously, as I just mentioned in the previous slide, it's pretty steep penalties and late interest if you don't stay on top of when some of these final calculations are due. Also, another kind of fumble is this failing to close out project funds, where you just leave small balances there, or maybe you've actually spent all the money, but you forgot to transfer the money out of this account into another account. It's best to just stay on top of these types of things and get these accounts closed out when the bond proceeds are expended. Save yourself a lot of time and headache of tracking these small balance accounts for many, many years after the bond proceeds are truly spent, just didn't get it transferred out of that account. One other kind of hiccup is these overfunding of your debt service accounts. So there might be very good business reasons or very prudent business reasons to have a rainy day fund or some additional amount set aside. But as I've mentioned previously, the IRS doesn't like to see this, right? Even though rating agencies like it, the federal government does not. So you have to kind of walk this balance between what's acceptable to rating agencies and business purposes versus do I have to worry about arbitrage compliance on these types of debt service accounts. Another common mistake we see is just the failure to take advantage of these spending exceptions. And I can't tell you how many times issuers have missed one of the benchmarks by just a month or a very small amount. So, we hate to see that. So be mindful that a 6-month target is coming up. What do I have to spend? Okay, I'm going to clear it. No, I'm not. Just be on top of these types of things and be cognizant of what the requirements are, because obviously, as I mentioned earlier, it could save you a lot of money in the event that you do meet one of these spending exceptions. Also, we've had clients who just basically are issuers we've worked with who have basically said, oh, let's just do reports every 5 years. And that's fine. Everybody hit snooze for a really long time because of interest rates were so low. But then they were surprised when we told them that you're actually going to have to make a payment to the Treasury. So last thing you want to do is wait full 5 years and then basically use up all that 60 days to get your payment due or get your records put together. And then you don't leave yourself enough time to kind of digest the fact that you owe several $100,000. Where's that money coming from? We've already spent our bond proceeds, kind of just struggling with trying to get money to make the rebate payment. So we would recommend clients look at these types of issues or look at their liabilities periodically and not be surprised at that 5th anniversary date, especially today in today's interest rate cycle, given the differences between rebate and yield restriction. You really need to be staying on top of these things versus waiting until the 5-year anniversary date. One other mistake or hurdle you'll have to deal with potentially is an IRS phone call where they're saying they want to audit one of your bond issues. So we always recommend that you do your due diligence before picking up that call or returning that call. Just be aware of the details of that bond issue. How was the bond issue structured? Was it new money, refunding? What was my arbitrage yield? How did I invest the funds? Have I done arbitrage reporting? Just think through some of these things that the IRS agent is going to be asking about so that you can speak knowledgeably about the transaction. And obviously, we want to give just the right of information to the IRS. We don't want to give them more information or have them change their document request letter because of something you said on the phone, right? You want to make sure that you're only providing them exactly what they're asking for. Also, we have clients who have established post-issuance compliance policies, but then they fail to follow them. So you want to make sure that you're aware that's what's in your policies and you set them up because you knew it was a good practice or a good reason to do that in the first place, right? You wanted to know who was handling your arbitrage, who was going to be responsible for record retention, those types of things. But it's worse if you set up these policies and then never follow them. So you want to make sure that you're annually reviewing them, they're staying fresh, everyone on your team understands what's in these policies, and you're kind of thinking through them. I think one of the general points of a policy is to attend training like today's training session, those types of things, just to stay informed of what's going on in the post-issuance compliance realm. Okay, and then the last bullet point or mistake is to assume that making a rebate payment is bad. So obviously for 15 years, you basically could earn very little interest earnings. And so you didn't have to worry about arbitrage rebate. But, basically you still get to keep the majority of your interest earnings. You're just having to remit back some slice of that back to the federal government. So at least now you have the ability to earn the positive arbitrage, earn up to your arbitrage limit, and know that you're able to retain the majority of it. It's just the small sliver that you have to pay back. So yes, it maybe is another little hurdle of having to quantify it and fill out a form and set it into the Treasury. But trust me, I think that's far better than all the negative arbitrage that we've been seeing for 10 or 15 bond years or so. So With that, I think that's turning over for any questions for any of the panelists. We'd be glad to answer.
Yes, thank you, Lisa, Sandy, and Laura. If you have any questions, please go ahead and put them in the Q&A section of the Zoom webinar. We don't have any yet. We'll hang around for a minute or so, a couple of minutes, see if we get any questions input here. Is there anything else, Lisa, Sandy, or Laura, that you'd like to add on as kind of last thoughts?
I would just like to thank you, Dylan. I would just like to reiterate Sandy's last point that making an arbitrage or rebate payment back to the IRS is not bad. It just means that you earned above your ARB yield and you were never entitled to that amount of money anyway. So because you signed the tax certificate, it wasn't ever yours to keep. But that being said, Sandy, I would appreciate it if you could just walk us through at a high level, what does that process look like to actually make a rebate payment back to the feds?
Right. So as I mentioned, there's an 8038T form, which looks a lot like the 8038G, which is filed at closing. It has some information about the issuer, what the computation date looks like. Is this a rebate payment or a yield reduction payment? Do you have unspent bond proceeds? Is it a variable rate or a fixed rate bond issue? Some information like that, basically. So it's just a transmittal letter that you would prepare or your arbitrage consultant would prepare. And it has to be signed by the issuer. And then basically you would also attach a check made payable to the IRS Treasury. And on the check, you should put your federal ID number, the EIN, on the check itself, because that's how the IRS tracks you for credit for your payment. So in the future, if you ever wanted to get a refund claim where for some reason interest rates dropped and you were able to get some of that arbitrage back under a refund claim, that's how the IRS would be able to find that you actually made a payment in the past, and they would need to find that before they could ever grant a refund claim. So all of these things, a cover letter, a simple cover letter, the 8038T, and a check should be sent to the Ogden, Utah IRS Processing Center. All of that is on the form. And basically you just want to make sure that you postmark it by that 60-day date, right? So if it's not paid within those 60 days, that's when I mentioned you definitely want to talk to bond counsel, because you're going to have to fill out a late payment explanation letter, and you have to explain why it was late, how many other late payments you've had, some information about the issuance, the issuer, and those types of things. And it basically, you're asking the IRS to please waive the willful neglect 50% penalty because it was X reason, right? So, so it's a pretty simple process, but you basically have to fill out a form and get that sent into the Treasury. But one of the things I just thought of, we've had so many questions in the last month or two, or basically last year, given COVID and the delay in spending for a lot of issuers across the country because of the supply chain disruptions. A lot of issuers are sitting on unspent money. And when they issued the bonds, they had every intention of spending the money in 3 years, but they're really struggling now to get that money spent. So you really need to talk to bond counsel and figure out if there's the potential to apply those funds to another type of project, very similar to your original issuance. But again, it's a state law requirement, but you need to think through how else you could get those monies spent, because you don't want to hang on to these bond proceeds forever, because then it starts to challenge your next issuance and what's your reasonable expectation about spending the money in 3 years when you can't spend the proceeds from your 2016 bonds or your 2018 bonds. So all of this is a reasonable expectation at closing, but it starts to question your ability to come up with a reasonable expectation the next time around. So, you know, we have a lot of issuers just clamoring, trying to figure out how to get this money spent. Now they're earning a lot of positive arbitrage on the money because of high interest rates, and worried they have to make a yield reduction payment, worried that they're going to get in trouble because they have unspent money. But really, you just need to do what you can, and unfortunately probably have to try to yield restrict it somehow or remit the excess back to the Treasury.
Thanks, Sandy, for walking us through that. And Laura, I do have one quick question for you before Dylan, we wrap it up here. But Laura, how do your clients typically manage their investments of their bond proceeds? Are they doing it like bond issue by bond issue? Is there, one strategy that they usually deploy comprehensively? What do you typically see?
I would kind of say it's mixed. You'll have some, that will manage specifically to a bond proceed. And honestly, in the last, year and a half, a lot of them, like I said, will just, even if you issued debt twice last year, you probably would have set up your 2022A and your 2022B accounts just because of where rates have gone. You probably socked it into an LGIP. I'm sure that you guys have seen that in your office with Star Ohio, that you've had a lot of debt issuance, and then even local governments that are putting it into a short-term fund such as an LGIP. And then you'll have some that, like at State of Georgia, we actually kind of ran a commingled type of portfolio where new bond proceeds came in, and so you're really kind of managing around, and I would honestly say it's a little bit easier, if you're issuing debt twice a year and now you've got new cash come in, and the new cash just happens to go into, your very liquid investment vehicle, and maybe you bought out 2-year treasuries. But obviously you can manage it as a whole, right? But you also, back to everything we've talked about today, you have to maintain all the records specifically for that bond portfolio. So it would really just kind of be like, how do you want to handle this? And, somebody might say it's just easy for me just to keep them all separate and not have it. And then I've got beautiful records. So I would say it's just 50-50 probably.
And Laura, I see a lot of clients who'll just park the money with their local bank, and the bank will guarantee them a rate. Like what are the requirements under the regs for setting the rate?
Really, that's probably just working it out with your bank. I mean, I know long time ago, a lot of them would do those, and of course, right on the spot, I'm like blanking, but it was like a repo type of product where the balance could decrease. It was an overnight repo product, but you're really probably negotiating with the bank. I don't think we see, probably don't see as much of that. I would probably honestly say you saw that a lot when rates were at zero, because they just didn't care and it didn't matter. So we'll just park it in the bank because they weren't getting much from their investment pool. They weren't getting much from a 2-year treasury. So it was probably just an easy way to kind of discuss it with the bank. But I think folks are getting a little bit more, are paying attention to more, to your point of, earning a positive arbitrage, knowing that potentially rates 2 years from now might not be where they are now.
Right, exactly. So that's why a lot of times I'll tell issuers, invest how you can, invest how you would normally would. I don't say sky's the limit, but we just don't know what's going to happen next year with rates. So why not earn it now and then deal with the consequences of potentially having to make a payment? But who knows, by the time you ultimately spend all your proceeds, you might not be in a positive arbitrage situation. We just don't know what's going to happen with future rates. So don't lock yourself into some below market rate right now when we just don't know what's going to happen. Don't try to manage the process right now on a low interest security to, this doesn't make sense.
Thank you so much, Sandy, Laura, and Lisa.